just go back. We'll let it flow however it flows.
Yeah,
And of
I've
course,
been negative.
we got to answer the questions in the chat when we're done because we want to help everybody as much as possible.
Oh,
So I'll let
exactly.
you go first. Let's tell them what we're doing today, and then you fire away.
Yeah. All right. Well, I mean, Jack, you and I have partnered up on a few things here, and you very pointedly asked me how in the world I'm able to come up with some of this stuff. And me, I have always had a wild curiosity about how market makers operate. I have some theories. I've got some questions written down. I'm going to ask you about how some of this stuff works. And you're the man that said you could probably tell me at least some of it. And we'll see what we can uncover here today.
All right. Now, just so everybody understands, I luckily got hired as an assistant in the trading department of a NASDAQ market making firm back in the 80s. Then the head trader left for another firm, and I got to take his position. I was 27 years old. And I had a great time doing that. And I moved from the market making side into the hedge fund side because I had a customer I was executing trades for. And so that's how I got my background in it. And Jeffrey's always amazed me because he's probably the only guy I know that doesn't have any kind of Wall Street connection, yet he's been able to do a fantastic job in his own trading. So that's a little background on both of us. And lay it on me, Daddy.
I just wanted to know how you went down the path to get started. I mean, you said you got lucky enough to get hired, but how in the world did you even come to that, like that you wanted to do this?
So, I got fired from Dean Witter exactly 1 year to the day after I started. And that was probably the lowest point in my life. My confidence was ruined. I wasn't good at selling mutual funds over the telephone. They wanted us to make 300 cold calls a day as a stockbroker with Dean Witter at selling a government mutual fund. And I couldn't cut it, and I got fired. But I had met a guy from another firm, and he needed an assistant, and just out of the blue, I got that job, just totally out of the blue. And once I got in they had a Chinese wall is what they called it, but brokers could not come into the trading department. They had like a little Dutch door. They had to put their paper tickets in there when they wanted to enter a buy or sell order. And in that environment with that mentor, I think everybody really needs a mentor, but in that environment, trading, where I wasn't distracted with stuff and I could just focus on what the job was, I just really thrived in that. Like, I took to it like a duck to water. And when the other guy left, I was more than happy to take that job. And then I did the same thing I was the head trader for two other brokers firms before I went and got into my hedge fund business. But yeah, I fell into it by dumb luck. I thrived at it tremendously, set all kind of records, and really loved it. We had so much fun doing that. So much shenanigans you can get away with when you're a broker dealer, a member firm. It was a lot more fun than the hedge fund side. We could really get a lot more crazy stuff going on. So that's how I got into it.
Yeah. So there's this wild, conception you hear all the time about market makers being able to see all the orders, the whole order book. Is there truth in that? I mean,
there is now. There wasn't then. They have I don't know, like a level 3 or 4 now that you can see the whole book on what's going on. This is a new product from NASDAQ itself that you could see that, but back then you couldn't. But they had a program called Instanet that institutions could trade on that market makers couldn't even see it, and they'd have an eye-only order on this little terminal. And that meant only other institutions could see that order. So NASDAQ market makers couldn't see everything out there. They could see everything inside their own firm, which gave them an unbelievable advantage. If everybody was buying Microsoft, I could buy it on the bid, sell it to them on the offer, and do great. But we could not see every single order.
All right. So this payment for order flow stuff that you hear these days, is that a huge advantage for guys doing this kind of market making stuff, or is it just kind of noise?
It's kind of noise. It doesn't improve or or make a bad execution for the customer, because what's happening is you could actually get a better fill with payment for order flow because of the timing of it. And it's not so much market makers that want to do this payment for order flow, but it's prop firms, proprietary trading firms. And like in New York, they'll go to the greatest length to get a data like a millisecond faster than the other guys, whether that means they have to be closer to the source, or it's just crazy how they do it. But for them, payment for order flow just gives them the opportunity to make a penny, penny and a half, 2 pennies on the order itself. And it doesn't really affect the public one bit. It sounds like a bad practice that you're selling pay. I mean, even Schwab does it. The biggest one that got busted publicly was Robinhood, but it's not necessarily a bad thing. And a lot of times you can get even a really great fill on your trade, even with a company that does payment for order flow, because they're
Well, I don't know
not
about.
interested in the price you get. They're just interested in, did they make a penny off that trade, off that execution. So yeah, I
Yeah,
think
I mean, when I see it and see the orders, a lot of times my order fill gets reported to 4 decimal places, but my
yeah,
pricing and my broker only gives me 2 decimal places. So they're playing out there in those fractions of a penny where,
yeah, out there.
I can't even trade there. So
Yeah,
that's what I figured, based on my information. So,
it also changed a lot back in the day. Stocks traded in either a 32nd between the bid and the ask, a 16th, an eighth, a quarter. They didn't trade in these penny units. They traded in, like eighths of a dollar, quarter of a dollar. So those spreads were a lot bigger. Now sometimes you could see where it's just a couple cents between the bid and the ask. So that's changed a lot too.
yeah, I see traders complaining about the options pricing. Sometimes you can only get it in 5 cent increments, and I'm like, oh, you don't understand. Like back, when I started playing the stock market game, I remember stuff like the eighths and the quarters and
Yeah.
and I was just a young fellow back then, but I still remember that kind of pricing. And people just don't understand how good we have it with the penny pricing, and even the multi-decimal pricing.
And the narrower spreads between the bid and the ask. A common myth, and I'll just address it up front. A common myth is that they think market makers move a stock bid one way or another. But the truth is, market makers don't care if the stock goes up or down, because they make the most money when the stock seeks a level where it yields the most volume, right? That way, if Microsoft just sits at one price, you're selling it at the offer, buying at the bid all day long, hundreds of thousands. I was on both sides of Oracle one time for a long time, and I'd do 280,000 shares a day for 3 to 6 cents. So they don't really care about pushing it around so much, except on the open, especially Monday morning. But the rest of the time, they just want that stock to seek the level that yields the most volume. The myth is that they want to push it around and ruin investors and traders, but that's not the case. They just want it to seek a level where it yields the most volume, because that's where they make the most money.
I've heard that market makers try to stay delta neutral, so you don't really care, like you said. Is that kind of the case?
I think that's more of an institutional or a prop firm. It's a little bit delta neutral, but depending upon the stock, if we made a market in a stock here, well, let me just tell you this: like, you have a market maker where you enter an order through that market maker, and that's a principal transaction, means he has to stand and be good for selling at the offer or buying on the bid. So if you brought an order to buy Microsoft to a broker dealer, and you were a stockbroker and your customer wanted to buy it, and he was a market maker in it, then he had to guarantee you a fill at the ask price. If you didn't make a market in it, then you were acting as an agent, and you weren't obligated to buy or sell at the bid or the ask. Whereas if you're a principal market maker, even if you weren't high bid, if an order came in, you would have to fill it at whatever the high bid was. So that's just a little difference between the principal transaction and the agency transaction. But now, anybody individually can even be a market maker. You could put an order in there and be the high bid and get filled easily. So the public has been able to kind of step on their toes and move right in, especially in the options market where you can, put an order in there on a limit. And you could buy them in the middle. You can buy them a little bit higher than the bid. You don't have to pay the ask price. So the option stuff and the NASDAQ market making stuff is a lot different, but there's still wide spreads on options, and there's not that really widespread on stocks anymore.
All right. So did you guys keep a supply of whatever stock you were making market in, or were you able to just kind of trade on a whim?
No supply, not so much, because what would happen is every broker dealer has these net capital requirements. And if you fall below that, you're in jeopardy of losing your firm or being shut down or suspended. So we didn't want to have a lot of stock long on the books, because what they would do is they'd have to do a thing called mark to the market. So, if you had a bunch of stock at one price and it went down $1 and you had 100,000 shares, then when you do a mark to market, the trading department just lost $100,000. Now they didn't really lose that. That was a paper loss. The next day it might have been up $1, but that's why you wouldn't stay long a bunch of stuff. And the riskier and more volatile the stock was, the more I would just short it and just build up a short position and then wait for it to eventually come back and cover my short. But most of the stuff we did, I'd short it. Anything anybody wanted to buy, I'd short it to them at the asking price and try to cover below that.
But yeah, so there's this common market makers chasing stops. So that's not really something that is reality.
That's not reality at all. I see these guys. I saw a guy had a whole course on how to trade stops, or how to pick off stops. But you can see that in the options market, which is why you never want to use a stop order on an option trade. You want to use a mental stop where you say, hey, if I'm down 20% or 50%, that's where I'm throwing in the towel. But you never want to put in a real stop, because options market makers, they can see that. But on a NASDAQ stock, it really doesn't even matter. I had this conversation with a guy, again, on Microsoft. Let's just say Microsoft's at 300. Well, if a guy puts an order in there with a stop at 290, there's no way to push Microsoft down from 300 to 290 to take that guy out, right? No one market maker can push around a stock. And you can't take that guy out at 290 if the market price is 300. So there's no real point in chasing stops, that unless you're short and you want to cover and a guy has a stop in, then you would take him out, but you don't really see it as a stop order. That's a crazy bad myth. I wouldn't chase stops.
Well, I do believe you on the options one, because I've tested that with real money. I've set that stop down there and watched the bid ask jump out until it gets me. And it works almost on a time, like it's almost like clockwork that it'll start spreading, and every couple minutes it'll get a little wider and a little wider and a little wider, and then it comes to get you, and then it tightens right back up where it was before you put that order on. Exactly. I've watched it happen.
That's crazy stuff. And the biggest advantage market makers have is on the open. And this is something everybody on here should write this down, is that amateurs control the open and professionals control the close. So the best money we ever made was on Monday morning. They have this thing called news flow theory. So news would come out about some stock we were making a market in that had some cancer thing going on. And the news would flow out over the weekend. And then on Monday morning, I would come in, and I had 2 assistants, and the brokers were already in, and they were bringing in, slips, blue for buy, pink for sell. And then all these orders were stacked up to buy XYZ stock. and on Monday, and they'd have it market on open. You never, ever, ever, ever want to put an order in before the market opens and you put it in. Well, at the market is a terrible way to enter an order, really. You never want to do it at the market unless it's moving real fast, then you can just get in on at the market. But what they would do is they'd say a market on open means I don't care what price I get filled at, I just want to get filled. So let's say the stock closed at $25 on Friday. Then on Monday it's open and it looks like it's going to open at 30. And every market maker that made a market in that stock before the market would open would jack up the price of their bid and ask on that particular stock. And then the very minute that bell opened, we'd have to timestamp all these orders, and I'd have my assistants just timestamp a whole sweep of them like at 30. But once we got everybody that wanted to buy, once we got them filled, 15 minutes later, everybody, the greed factor was so intense, man, that they just got killed. They'd buy it at 30, it'd be back down to 27, in that first hour, and we would just absolutely positively clean up on that. Same thing on Tuesday. Then as the week goes by, there was a little less of that, but Monday morning, market on open, or anytime you see a news story before the market opens, don't buy it market on open. That's the biggest, riskiest, worst trade you can get. And if it wasn't for those, market makers wouldn't be making as much money as they. I mean, that's a dangerous thing, and that's just greed. People see it and they say, I don't care what price I pay, I just want to get in on this cancer cure drug or whatever, and they never made any money on that because they paid such an inflated price.
And one of the friends that I learned, that one of my mentors along the way, used to call it amateur hour, and that was
what it is. Amateurs control the open and pros control the close. Now, if anybody has the time today, watch what happens. It used to be the last hour, but now it's about the last 20, 15, even 10 minutes. Whatever direction the market's going in or a stock's going in that last time, it's going to continue to go in that direction. And it's the pros that control that close, whereas the amateurs control the open. So that's a great tip everybody should write down. And sometimes you can get your best trades done in the last hour as opposed to the first hour. But generally speaking, all the money we made, even when I was doing my day trading hedge fund, if I would have just quit an hour and a half after the market opened and gone home, I would have made way more money because I was giving it back, throughout the day. It was just harder, not as easy as that first hour.
A lot of people put focus on this market on close orders, like what the number is going to be. How does that exactly work? Like, what does that mean?
Market on close is you want to buy it at whatever the market price is at the close, like right in that last few seconds. So you want to get that closing price, no different. And that's important to guys that put on that trade earlier in the morning. And it's also important for guys that want to put on a trade at the very, very close so that they can trade that on the open the next morning. Yeah. So that's how that works. It's all professionals in there on the close, and trying to go against those guys, it just won't work.
So you don't really know what their plan is, whether they're closing out the day's position or positioning for tomorrow.
Yeah,
is what you're trying to say right there.
Whatever direction it's going, it's going to continue, and nothing's going to reverse in that last 10 minutes. It's only going to get higher, especially if there's a lot of options tied to that stock at that price too.
Yeah. So as a market maker, you didn't really deal in options. That's a separate market maker thing, or
it's a separate market maker thing. Yeah, you had to be a New York Stock Exchange member firm as opposed to just a NASD member firm. So we did a lot of options, but we couldn't front run an options trade. We'd have to send it right down to our New York Stock Exchange clearing partner. So that wasn't so much of a gold mine as the NASDAQ stocks were.
All right. So were you a market maker for all the NASDAQ, or did you have specific buckets that you were allowed to be in?
We could be in anything. At one firm I was at, I always kind of had total control in the firm. I didn't even let the guy that owned the firm in the trading department. I didn't want to mess around with my business. So at one point I was making a market in 68 stocks simultaneously. but I had a lot of assistance, and we had all these screens and stuff would light up, and that was great. But most of the time, you're just going to make a NASDAQ market making firm is only going to make a market in a stock that it's a principal in. Either it participated in the IPO, or the brokers just have a large appetite for it. Then they'll make a market in that stock. It's more profitable to do that, to make a market, because the whole idea is that buyers pay the ask and sellers get the bid price, and the market maker gets the stuff in the middle. Now, if you're not making a market, then you just have to fill that guy at the offer through another broker, and you can't make any money on that. So that was the good stuff, making a market in NASDAQ stocks, and you could pick which ones you wanted to make a market in. You didn't have to make a market in all of them. You could do them as an agent, or if you made a market, then you were doing a transaction as a principal.
All right. So, can you clarify a little better what that agent versus, principal really means for, for those of us that didn't live that life?
Yeah. A principal means you had to have a due diligence file, and you have to have that kept up to date. And the main thing was you had to be willing and able to stand in and sell it at the offer price, even if you weren't one of the brokers on the offer. So we had an old Harris machine and a NASDAQ machine, and it would list by 4 letters every broker that was on the bid or the ask. So you could see there's 10 market makers on the bid and just 2 on the ask, right? So that would kind of tell you, hey, this thing's about to go higher because you got 10 guys willing to buy it and only 2 guys willing to sell it. And the public could not see that, but we could see how stacked up it was. If you had 20 guys on the ask and 1 guy on the bid, they were going to hammer that guy and he'd fall down. What I would like to do, my biggest trick was I'd like to short a stock that I knew was kind of coming down. I'd just see all this order flow, and then I'd be the only bid, right? And they'd hammer the bid. Your phone's ringing. They got stock to sell, and they keep waiting for it to go down, hammering me, and I wouldn't budge. I'd stay right there. And then some of the guys would just think, well, this is crazy. I'm just going to short it to this guy. He's the only bid. There's 20 guys on the ask. So I'd take it all in, and then there'd be 20 guys, and there'd be 19 on the ask, right? And just me on the bid, then 17. They got done selling, and they realized I wasn't moving because I had such a huge short. Now there's 1 guy on the ask. I'd take him out, right? Stock would go up a quarter. I'd sell everything I had. Take.
So that's the crazy games that you're able to play, and you're really playing against other market makers, not really the retail people.
Then even the better game was I'd be on the ask, and I'd have a friend of mine that they had these wholesale market makers where they didn't have brokers. They just were buying and selling. So I'd call him up and I'd say, hey, sit on the bid on Oracle. I'm good for 100,000 shares, right? So now they don't even know it's me. I'm on the ask, looking like I'm a seller, but I'm really a buyer through a friend of mine, right? There's no way to figure out that the firm I work with was the real buyer, because I'm sitting on the offer looking like I'm a big seller, and I got a buddy of mine all by himself on the bid, a quarter lower. And it was unbelievable. You can't do that kind of stuff as an individual trader. You need that network and some friends, and then you always had some guys you liked, and you always had some guys you hated. Goldman was notorious for being the lone bid, and then everybody would hit the bid, waiting for the guy to go down. He wouldn't go down. Goldman was one of the biggest game players, and a lot of people would see Goldman on the bid and they would just join him, on the bid and think, hey, Goldman's buying, so maybe it's going up. And then, he'd actually sell it to the other guy on the bid through a friend of his, and then he'd drop his bid. I mean, it was wild, man. It was wild.
So, so you guys played against each other. I mean, that was rip the other guys, like you said, you had your friends, you had your enemies, and, it was battle essentially.
Even your friends would throw you under a bus, though, without hesitation. Some guys would, they'd bury their own mother for a 16th of a point. It's just ruthless stuff.
I've heard it's a game of cutthroat. It's all about the dollars you have in your account at the end of the day.
That's right. And there's a lot of hatred. There's a lot of hatred in there. I remember when Stratton Oakmont went out of business, and we were shorting all of their deals, just wildly shorting everything they made a market in or everything they brought in. We'd get threats. Some guys are going to come from New York to Colorado with baseball bats and, this kind of stuff. And I got one of those calls one time, right when Stratton Oakmont, this was the guy, Wolf of Wall Street, right when they went out of business. And I got one of these calls from some of their tough guys. And I said, listen, this was before the internet was big. I said, listen, get your pen out and write this address down. This is where I'm at in Englewood, Colorado. I don't want you to go to the wrong place. If you're threatening me, make sure you show up right place. Okay. Of course they never do, but the shenanigans was crazy. And that's why you see the price change so fast. When you're looking at these things on level 2 or whatever you got for your broker, it's just amazing how fast in real time the prices are changing. Just a penny, half a penny, whatever, but constantly going. Very competitive.
So what was the time frame chart that market makers use? Like
None.
I've heard a lot of misconceptions about this.
None.
Don't even look at a chart.
And there's no point looking at the chart. I'm just worried about the next second, the next fill.
All right.
If I'm short and I'm watching it go up, then you start sweating. Things like that. But there's no chart. They didn't care about the fundamentals. We didn't even know what the company did, but you had to have that file with what they had, a prospectus, that came out when they went public. You'd have to have that file and these quarterly reports and annual reports. And I just had this one young lady in there and she kept that all up for me, but I never read what the company did. It didn't matter to me. It was just 4 letters and 2 prices. And, I'm going off that action. So yeah, there was no charts, no fundamental analysis, no technical analysis, no care if the stock, we didn't care if it went up or down. We didn't look at any fundamentals or any technical. There wasn't a lot of technical back then. And it was happening too fast. You're adjusting your prices on your computer. And I had one phone with the spiral cord and the rubber on it so you could hold it on your head. You had another one I'd hold up here and people are yelling at me and you're adjusting your prices. There was no time to look at a chart. It was just all day long, man. No lunch. We were trapped in there from the market open to the market close, and no getting out of there. Yeah, it was.
Yeah, that's another misconception. That lunch hour, like all the market makers and the hedge funds going to lunch, and it kind of dying down. Like
it dies down just because there's a lack. Most of the orders, the first hour and a half. If you look at a daily volume, it's all happening in that first part of the day's session, and it calms down at lunch just from exhaustion and lack of order flow. It's not calmed down because anybody's left the trading desk. It's just that there's a lack of orders in the middle of the day. Not nearly as much in the middle of the day as there is in the open and the close.
I think it has to do with the news that's anticipated and happening. Like everybody's trying to make that buck, and that's one of the most dangerous things I think you can do is try to trade news. But that's just my own opinion.
Stuff that gaps up, stuff that gaps down. I love that. I love the gap up and the gap down. And then when I left the market making side, I would love to short a stock that gapped up. Still do, or go long a stock that's gapped down. If I see something that's gapped up an abnormal amount relative to how it's normally gone up, I'll short that or buy puts on it, and you can cover those the same day, and that's a really good thing. Or not so much gap down, but my thing was always stuff that gapped up. I just good news that can make a stock go up, but it can't make a stock stay up.
Right.
We'd raise the price on them so high it was ridiculous. Fill all those guys, short it to them, and just wait. It'll come back down and clean up.
I see those, I do a morning show and cover stuff that's popping pre-market a lot of times. And you see a lot of those, they call them Death Star type candles where you got that big long tail and that little bitty body down at the bottom.
Yeah. Now, do you short those kind of things when you see a gap or go long?
I'm not a big day trader, honestly. I tend to take advantage of longer term trades because that's just what I've been good at. I never had a mentor teach me how to day trade, and so I've picked up a little bit over the years. And there's one particular stock that I watch daily that I find closes that gap quite reliably, up and down. And we've shared that before.
Love that.
You've helped me show that one, and that one is an ETF, and it just happens to do that all the time. But it's not a universal for me. Some stuff will do it, some stuff won't do it. And
Here's an interesting thing to think about today. At one time I was one of the biggest market makers, and I don't day trade at all. I wouldn't even think about doing it. It's the riskiest, hardest thing to do. People say, "Hey, will you teach me how to do it?" I tell them no. I wouldn't do it as a retail trader. I think it's very, very, very difficult to do that, and it requires a ton of time. And I have sat in front of the computer all day for so long that I can't even stand to do it now. Really, I can't. I couldn't sit in front of a computer all day long. There's no real money in it either. Like, I would see guys get all chopped up and maybe make $150 at the end of the day for all that stress and worry. And then are you going to hold stuff overnight, or are you going to be flat to the share at the end of the day? With my fund, we day traded all day long, hundreds of trades, but we were flat to the share at the end of the day. Next day, you start all over. So, yeah, the day trading game is tough unless you have an edge like you have, which is something I think you might want to recommend that to people.
Yeah, it is my opening bell alerts. And the ticker, for those wondering, that's IWM. It's the small caps. I just find that the news there is kind of like Jack saying, the news there, it moves the index, but then the news can't keep it there. And the institutional flow, I feel like, brings it back quite quickly on that one.
Yeah.
And it's just one of those anomalies in the market that I learned from. I actually got that tip handed down to me through a couple people from New York. A Wall Street trader is the one that tipped a friend of mine off to that, and one of my mentors in the past.
That's an anomaly. That's an anomaly, and that's a great thing that you have with that. You really got a great edge there.
Yeah, I pride myself in being able to see patterns and things in the market. Just, it's not like I trained myself to do it. I just have this innate ability to do it. And my wife says it's really uncanny. It's just one of those things.
It's the two or three things you've shown me. I didn't think anybody could ever crack the code like that. I mean, you're really brilliant, and all your people should really take your advice to heart. I see this guy Paul has a question. Whenever you're able to answer it, it's fine. He says, but I'm trying to get more into day trading stocks, getting out of the most manipulative market, which is crypto. So what's the best platform or exchange you would recommend? Well, Paul, I'd recommend not day trading. It's, some directional trading in that 2 to 10 day time frame can be easier and more profitable than day trading, which is why I don't even day trade anymore. And I just use Schwab, and Schwab's has worked really good for me. You can trade pre-market and post-market at Schwab. You could put a limit on a net credit order. I mean, it's just good, really good.
I do outside of IWM, I do a little bit of day trading, and it's primarily in micro futures. And I just do that to keep myself from doing stupid stuff during the day. I can see these little patterns. You can get in and out. They're very liquid. And I'll make a few bucks. It's not like I'm walking away with hundreds of bucks. My futures account is $500. I'm looking to make $10 today on a micro future, which you can make that in a few points usually. So
yeah. So Barry says, Jack, you don't use stops on options. What about closing limit orders? Yeah, I use closing limit orders all the time. So like if I have a credit spread on, which I always do every week, like a minute or two before the market closes on Friday, I'll buy back my short put or my short call if it's out of the money, even just for a penny, because What people don't realize is that when the market closes on stocks at 4 o'clock, it's closed. But the CBOE has until 11:39 Saturday night to assign a position. So let's just say NVIDIA, it's flying high. And then the CEO gets caught with a bunch of prostitutes and a half a pound of cocaine, and then the plane crashes. Right, the stock goes down 100 points after hours. So if you had any options in there, you're to buy call, you're going to get filled, and you won't have any way to get out. So on some of that stuff, you want to close that out, even when it's out of the money, and they should expire worthless. On some crazy tech stocks like NVIDIA, I'll close it out for a penny. I mean, if you make great money on the net credit, you can always give back a penny. It's very cheap insurance. I was showing my wife one of these trades on NVIDIA. I had a credit spread and I had some puts on there, and she says, well, what would happen if you had that stock put to you? I'd say, well, we'd end up owning about $1 million worth of NVIDIA, and she says, Jack, there's no way we can go have a weekend if I'm thinking about this in the back of my mind. So it's going to cost you what? $10 to get out of this, right? That's cheap insurance for your brain to not have to worry about that. So just keep that in mind. Other things like CMG, when those options are out of the money, I don't close that position out on things like that. But some of the tech stuff that's really wild, and if it's close, if it's within like 50 cents or $1 to your strike price, if it's only out of the money by about $1, I'd close that out too on Friday.
So you're talking about closing those options. Years ago, it's probably getting to be 15, 17 years ago when I learned options trading for the first time. I got into some guys that were doing back spreads. They would sell one and buy two. And what they were looking for at the time, I didn't really understand it all, but they were looking for pinning trades on Apple on that Friday. At the time it was weekly expirations. They were brand new, and Apple would have to happen. This was pre-split, 1 or 2 splits back when prices were, $400 or $500, and it would hop $5 increments right there Friday, the last hour before the close. And you could do a back spread down 2 strikes, and all of a sudden it would hop down there and you'd be in the money, and you'd rake it in because, your 2 longs on the back that you bought for 5 cents, all of a sudden they jumped up to be worth 50 cents or $1. And,
And you had some money to buy those because you sold a higher strike price option, right? So
right.
you used money from the proceeds of the sale to go along too.
To go with your story, one of them was out of the money. It was going to go to zero. Like I lost. I was like, I'm just going to lose. And after the market closed, I got filled on the short. And when I came back in Monday morning, I was short $2 million worth of Apple on in a $5,000 account. And unlike the Robinhood story, I knew how to get myself back out of it, or I worked out how to get myself back out of it. And the damage was about $100, but at the end of the day, but being short $2 million, getting the margin calls and all, your account restrictions for several days to follow, like it was gut-wrenching experience.
It's not worth killing yourself over like that guy did at Robinhood, because he was long 7 million or short $7 million. Here's what's going to happen. We had this happen when I was a market maker, and what would happen is, rather than you getting stuffed $2 million worth of Apple in your account, if you didn't have 2 million to cover it, what would happen is, and this is still going to happen, the brokerage firm is going to stick you with it, but it's in an escrow account they have, or just a blank account they have. It's not really in your account. Now, the next morning, let's say this happened on Friday and you got it stuck to you on Saturday morning because the position was still open with options, and they stick it to you. Then on Monday morning, they would just sell out that position, right? So maybe you're up or down $1 on all that. That's why you say the damage could just be looks like it's 2 million, but by the time they sell it, you could have ended up making $2,000, and they'd have to give you that $2,000 sellout. And if they sold you out and the loss was 2,000, then they're only going to hit you up for $2,000, not 2 million. And that's really the way it works. I mean, people think, oh my God. So that guy that was long or short 7.5 million, it looked like that in his account, but Robinhood was really the one holding that. And they were going to sell him out, and whatever he made or lost, they'd stick it to him. So I would never worry about that. I would, like I say, I wouldn't get too worried about that. But it's easier just to close the thing out rather than worrying about it, right? On Friday afternoon.
Yeah, and yeah, I learned my lesson there years ago, like I said, and I did learn. I learned that I needed to learn a lot more about options before I kept playing that game. So I went on a mission to learn about all the different ways that you can protect them and trade them and keep yourself out of situations like that. Yeah. And playing 0 days is can be dangerous, but if you do it smart, and usually if you're holding them long, you have low risk. It's when you start shorting them that you need to close them out.
So Dennis asks, Jack, did you say that you would exit your credit spread for a penny to 5 cents before the close on Friday? Yes, a lot of times I do. Sometimes I don't. It depends on the stock. But if I'm doing trading in NVIDIA, Tesla, some of the wild stuff that I love, I will. If it's something that's not so crazy like CMG, then I won't.
Let's see. Yeah. You got any questions for me?
Yeah,
how I got started?
Tell me what year you got started and how you got started and why. I always ask people, why are you in the market? It's not for everybody. Most people shouldn't be in it, but go ahead.
I have multiple levels of why I do what I do. And so the first real hook got me. I was in 3rd grade, riding the bus home, and the kid next to me, I don't remember if it was Coke or Pepsi. Knoxville's kind of a big Coke place, so it was probably Coke stock that his parents held in his name, and they gave him the cash dividend off those shares. And he had bought candy, I think it was candy, and he was showing it to me on the bus, and I was hooked. I had to know how you can own Coca-Cola as a company and get money. Like this is like, that had me hooked. So very, very quickly, I found myself playing what we called the stock market game. They still do this today in elementary and middle high schoolers are able to play this. At the time, we had to fill out Scantrons. You actually filled in the bubbles for your ticker and, your market order, limit order, whatever it was. And that's where the quarter points, the 16ths, the 8ths, we used to look it up in the newspaper. We'd make our picks, we'd mail it in. A couple of weeks later, we get the mail back. We'd open it, look at what our fills were, check the paper, see if we were up or down. There was no charting. There was no, beyond the newspaper and the Scantron. That was how I learned how to trade. So, it was a difficult way to trade, and we never did super great.
But the
I have to admit,
got you hooked, right?
Yeah, the dividends what really got me hooked, and I wanted to learn how to do it before, I put real money on it. My parents were like, yeah, let's not put real money in the market when you're 8, 9 years old, whatever it was. They're like, why don't you figure out more about it before?
That kid should have reinvested that dividend today. I got to tell you a really quick funny story. My little Jack, my grandson, he's my grandson, my grand moon, my grand stars, my grand universe. He's everything. So he comes into my office one time. We used to have him every summer come, and I'm sitting there in this leather couch I had in this little office, and he comes and sits down next to me, and he's looking at this screen with charts on it, and he says, "Papa, what are you doing?" And I said, "Well, I'm picking out some stocks I'm gonna buy," and I said, "This one right here is a real good one," and he says to me in the most snarky tone, he says, "How do you know?" I love that question. Absolutely love that question. I didn't like the tone, but I liked the question. I said, "Jack, ask that anytime anybody says they got a good stock for you or a good investment, ask them, how do you know?" And then I kind of explained to him that I've been trading stocks since Moby Dick were a sardine, and I kind of know what I'm doing. So he gets into this, and I'm telling him about dividends. He's in love with Aflac because he's watching college football, and there's all these Aflac commercials on. So he really doesn't care too much about the chart. He knows that if you look at a 5-year chart, it shouldn't be going down every year for 5 years. It's probably going out of business, but he'll look at the chart. But the main thing he looks at is the dividend. And it came down to where we'd pull up a new stock and looking at different stocks. And his question was, how much does that one pay you to own it? That's how he looked at dividends. I absolutely love that. How much does that one pay you to own it? You know, can you imagine that, just living off of dividends? That'd be like pure heaven, man.
Yeah. So the next level of my story keeps this theme going though with the dividends. So when I turned 18 back in the late 90s and graduated high school, I opened an IRA account. I was like, I'm making a little money. I want to offset make it so I don't pay taxes. Really, I'm going to put this $500 that I can barely afford into a traditional IRA and make my tax bill less. Like, this was like the genius idea I came up with. Didn't know or understand what a Roth IRA was at the time, but the next year I had learned that. But I didn't want to pay the government any taxes. I wanted to turn my money around, start making money. So I did this, and then I opened an E-Trade account to do it. And then I was like, gee, what do I do? So I had I have an uncle that works for, let's say, Snedward Jones, maybe, runs an office. And I called him up and said, hey, how do I learn how to do this? He said, I'll tell you some advice. I want you to listen to it, heed it, and follow it. He said, I want you to take your money back out of that E-Trade account, close the account, never put another dollar into the stock market, and stay far away, because you are unlikely to ever get ahead playing the stock market.
Well, that's why Jones is one of the worst firms on the planet. But that was bad advice, man. You know that was bad.
Well, at that point, I was like motivated, supercharged motivated to figure out how to make this work. Like, that was like lighting a fire on me to get me where I am right here today.
Yeah.
And
it tells you can't, and you just have to do it.
I have another uncle that I can't remember the fund he used to work for, but he actually traveled the country creating baskets of smaller price stocks that he would sell to mutual funds. And I guess they were a fund themselves or whatever, and they would sell these baskets to retirement funds and hedge funds. And he would make like a thousandth of a penny on every share that was in the basket, but the volume was so incredibly crazy that he would pull down $1 million plus a year easily. Huge house, crazy cars and pools, and his kids all had all the stuff that I wanted growing up. And I was like, there's two different, a dichotomy of situations here. One guy, just making fractions of a penny, crushing it, and then the other guy telling me to never try to trade the market.
We're trying to trade it. That comes later. My oldest son, Jack, I bought him 7 shares of McDonald's for his 7th birthday, just for him to learn the stock market at 7 years old. They're never too young to start learning. Well, I got my little grandson is 3. He doesn't understand anything. At 7, they can get an idea of it, and they were paying like 50 cents dividend, and we'd be reinvesting that. And he still has the stock. He's 33 years old and made an absolute killing on McDonald's. On McDonald's, of all stocks, right? Reinvesting the dividend, and time does all the heavy lifting. And now he's, that little tiny 7 shares of McDonald's, it's split and it's gone up. And so, the wealth building power of the market, it is there for good investing, and it can be great trading too, right?
Yeah. And I was going to say, like, moving on with the dividend theme, like one of the first ones I ever found myself in was a ticker called CARS. It was a real estate investment trust that owned dealerships and leased, bought the property, developed the dealership, and then leased it to the franchisees that run Chevy and Ford and whatever. And for a couple of years, I actually held that, getting that the monthly dividend was the key. I was getting a paycheck every month to own this thing. I'm with your grandson there. Like, how much is this thing paying me to own it? And I absolutely loved that concept. And I chased real estate investment trusts and other high dividend payers for a long time before I figured out the nuance in that with the interest rates and the whole thing there. And now I do that a little less, but I still have some definite monthly payers that I keep track of.
We got
And
Guilty Income Corp, ticker symbol O. I love that thing. It pays every month. You know, and you reinvest that dividend, and man, it's amazing how that will just pile up when you do that. And everything I have, I sell covered calls on as well, every dividend stock. And you could take the premium from that covered call and buy even more stock. That's like compounding on steroids, right?
yeah, I've been into computers since I was 2 years old. I'm an anomaly from the 80s. Most kids my age do not have that kind of experience in the markets, or with computers and the markets either. And so I was into computers, and on the back of the .com bust, I bought a stock called Red Hat Linux,
Oh,
and I paid $3.50 in that retirement account for it. And then when I first got into options, it was learning to sell covered calls on that Red Hat stock. That was the first thing I got into with options before I got into that backspread thing. And thank the good Lord, IBM bought that stock out from me for $129 here a couple of years ago. And I sold covered calls all along the way, and that $500 account turned into over, I think it was 29,000. And just on that one stock, holding it, throwing the covered calls to it. And you talk about that wealth building, that first $500, I've hardly done better than that, that multiplying that $500 into, I think it's a 30 something $1,000, almost $40,000 account right now. I'm very careful with it right now, because I don't want to lose that money I've accumulated.
I'll tell you two things about covered calls. Number one, that strategy has made more people more money than any other, probably all other options strategies combined. Number one reason is it's the oldest option strategy on the planet. Number two is anybody can do it. You don't need any special options level to be able to sell covered calls. And really the thing people don't realize about it is that it's less risky than owning a stock, because the minute you sell that covered call, you've lowered your cost basis on the stock by the amount of the premium you've received. And that's gone so far as the CBOE wrote a letter to the SEC in a comment that the covered call strategy was less risky than owning the stock. This is straight from the CBOE. And people think options are risky, and they are. When you're a buyer, you're going to get killed. But some option strategies are not risky at all. Like, for example, the covered call. So I encourage everybody on here now, any stock you own, if you have 100 shares, or if you don't have 100 shares, you might want to round up. But today, like if you got McDonald's, just go out about 30 to 40 days in expiration and look at a strike price that's about 7 to 10% higher than your cost basis or your purchase price in the stock. And just look at all the money. When you look at that options chain, that's a list of money people are willing to pay you. Millions and billions of dollars they're willing to pay, right? When you look at that options chain. So if you got 100 shares of a stock, just check out what the options are. It's like free money,
Yeah. And, one of the nerdy things that I've learned over the years about options chains, when you look at it, the naive condition is to sell calls. This is just the naive, when you're looking at a chain, that because of so many people that do this, it's selling calls and buying puts. So you'll see less credit on, or lower prices on the call side than you will the put side, because of that call selling and the put buying as the naive. That's just the unknowing condition, for people not knowing what the stock's going to do, or, whatever, it's the popular trade, as you say, and, probably makes more money than, if you've got the patience and the capital to be able to buy the shares and sell the calls, then it definitely.
If it pays a dividend, I really wouldn't own a stock that doesn't pay a dividend.
Well, you got to have liquid options too.
Yeah, that too. Yeah, but everything. I mean, I have this portfolio I call the freedom portfolio, where it doesn't matter to me what the gain or the loss is on the stocks. I look at the income And that portfolio throws off. I look at how much cash flow does this thing throw off every month? Because Coca-Cola could go from 60 to 30, they're still going to pay the dividend, right? That's the other thing people don't realize is that you're going to get paid. You're going to get paid dividend regardless of the price of the stock. So let time do the heavy lifting there.
Yeah, three of my favorite long-term hold stocks are actually covered call ETFs. They're XYLD for the S&P 500, QYLD for the QQQ, and RYLD for the small caps. And I hold I keep the blend kind of mixed a little bit. I don't have them evenly distributed because there's different opportunities in the different indexes, but they all pay a healthy 10+% dividend.
How about Jeffy, JEPI? You ever looked at that one?
I have, and I don't hold any currently, but one of my followers does have a significant holding in Jeffy.
What's crazy to me is, boring old covered calls. Who would have thought 5 years ago that there'd be an ETF that just does covered calls? If you would have told me that was going to happen 5 years ago, I would have bet my house that it wouldn't. I mean, you can do a covered call yourself. Why would you buy an ETF? I guess because it's totally hands off. But it was funny. There was an article in Barron's that talked about the booming ETFs that promised not to beat the market. And those were all these ETF covered call ETFs. They're not trying to beat the market. They're just trying to bring in monthly income. And a lot of them pay out monthly, which is awesome too.
Yeah, it's just like XYLD yield. It's like X yield, R yield, and Y yield. I typed that first one wrong there. XLY, it's XYLD. So it's they just do it for you, and they actually use the futures. They sell the credit in the futures market where it's a little more liquid, and they keep it rolled out a month in advance. And hey, I mean, I don't even have to worry about it. I just hold the ticker, and they pay me a month
on the ETF, right?
Yeah, but I got to have more money than just buying 30 shares.
Oh yeah.
So I'm not of extreme, extreme means, I guess you would say.
Neither, but I do what I can with what it is I got.
So, yeah. All right. Does anybody in the audience have any questions before we start maybe trying to wrap this up after an hour?
About market makers or anything. Any other questions?
Yeah. Any other questions? Anybody? So what's the most precarious position you've gotten yourself into with a position, Jack?
No, without question, Mass Tech. I shorted this stock. Word got out that I was short. They took it up in my face. It was the biggest loss I ever took in my life. It was dumb, just really dumb. I was really stupid to just watch this thing going higher and higher and higher while I was short. And I almost did the dumbest thing in the world, which is what they call financing your short. So let's say you're short a stock at 40, it goes to 60. You're getting your face ripped off, right? So you short more at 60 to bring your average cost up to 50. Calling finance. Yeah. You do that long enough until the point where you can't finance it anymore, you're totally wiped out. I've seen that happen to a guy. But Mass Tech, I'll never forget that. That put a hot branding iron on my brain. Never doing that again. I mean, I short stuff, but if I'm wrong, I'm wrong. I'll cover the short. I'm never going to sit there for 8 days watching these guys rip my head off. No way.
Yeah, I was trading with a guy in the futures market years ago, and he was like, I've got this genius plan. Watch, every time you're down, you just double down. Like if you're down by, you just double down what you're, and he lost $500,000 on one particular run that didn't just snap back. Like he was, after 2 months of trying these snapbacks, he was confident. He was confident that you could just double down when you're down and it would all come out in the wash. And it didn't come back before he got stopped out.
Good money after bad. But I used to hear the brokers out, and they had a bullpen out there, and I would hear this guy all the time. He was the worst broker there. He'd always get on the phone. He'd get real loud. He'd say, "Don't be a clown. Average down. Like you're already down." I got even one more crazy story I got to tell you before we wrap up. This happened in my very first couple days. I wasn't even in this brokerage firm a week, my very first job in a brokerage firm. And we used to have these desks were in like 4 desks, we'd have one Quotron in the middle, and you could spin this around. If you had a guy on the phone, he'd say, "What's IBM doing?" or whatever. And there was this one guy, Izzy Glass, and his partner. I don't remember him, but Izzy was always standing up, and he always had to control the monitor, and he's always biting his nails. And they were chain smoking in the office this back in the 80s. And one day I come in and I turn around, and I'm looking at Izzy standing there, and he just faints. The kind of faint where you don't even put your hands out to break your fall. The kind where you just break your fall with your own face. They hauled his ass out on a stretcher, and this guy never came to. And his buddy went out crying like a baby after him. And I talked to the owner of the farm. I said, "Malone, what the hell happened to Izzy?" And he says, "Carter, options are a zero-sum game. Don't ever buy options." And when a broker loses all of his own money in options, man, that's dude passed out right there from me. Then I'm on the phone with my sister. I'm like, "Man, I don't know, what kind of job is it where people are passing out in the office?" Yeah, I better go be a mailman. I don't know. This is wild.
That's a good story. Yeah, I've seen some crazy stuff on my end and always wondered about this. I appreciate your time, Jack. I did bring something that I've been working on for a year that I wanted to offer people. This is the first time I'm going to offer it. And I'm going to just do a little quick screen share. It's like 2 slides or something here. And, this just for tuning in today and spending a little time with us, I want to give you this offer to join this brand new thing. Like I said, I've been working on it for a year. This integrates all the nerdy stuff that I've learned along the way. It really does. I coded this myself. On Friday, we're going to be opening up a beta group for my latest secret project. I call it the VVD indicator, which is volume velocity divergence, nerdy language. Yeah. But what it does, it puts a buy entry right there in the chart, draws a target, and these reversals tend to work out. I've really been testing it. And for a thank you for those who joined us today, I want to give you an opportunity to join me on this beta test. It's not all fully honed in. This is new. It has some bugs, some little quirks. I've been working on it. I think I've updated the code 3 times this week already. And but I feel like it's kind of in a place where I need more feedback from more people. So we're making it available right here, jeffreytrader.com/VVD. You get lifetime access to the indicator, lifetime upgrades, instructions, quick start. I'm going to do a Q&A next week just to try to make sure that everybody's getting it. And I have a list of tickers that tend to work better than others. And we get a private Discord chat just for the beta members and we'll talk about this indicator and what it does.
You have impressed me more than anybody, even guys that I know in Wall Street, even guys in our industry, they can't hold a candle to you. You really are brilliant. And you always amaze me where you find something that's sitting there in broad daylight, but nobody else sees it. I mean, you got great vision, you got a great mind for this stuff, and I really admire your work. I think everybody here should just do themselves a favor and get in on this while you still can. It's going to work. Everything the guy does. I'll be in there with you.
So, to give you the one-line kind of pitch here, price moves and it comes to extremes, and volume has a velocity to it. There's volume that supports these moves both up and down. But when you get a divergence in the price extreme and in the volume, it tends to signal a reversal. And I figured out kind of a way to trade these potential reversals. And I throw it right there on the chart with a buy entry, a stop, and a target right on the chart for you with this indicator. And like I said, I use a lot of my nerdy stuff. I use Fibonacci stuff in there. I use, what they call a zigzag indicator. I use, cumulative volume delta. I use a lot of calculations, and it was pushing the limits of TradingView, what they would let me do with it. So, I hand coded it all myself, and I need people to help me test it.
Just did another thing by hand, figured out a You just do amazing work, man. I'm really a huge fan of what you do. So I'm going to be in on this. I think everybody ought to get in on this too.
Yeah, I'll send you the link, Jack, and you can check it out and see what you think.
So I guess our hour, they gave us an hour. Are we running?
Yeah, that's right at an hour. Any final questions for anybody? Looks like what platform it runs on TradingView right now. It's a TradingView indicator. Can I put it in something else? I have no idea. I spent a month getting it into TradingView, and that's what it runs on right now for the beta. And we'll see if we can do anything else. TradingView is free for everybody.
Do they need to run it, or do you give them the alert?
You actually get the indicator to do on your own chart. Like it's a link, it plugs right into TradingView. You don't even have, there's no configuring, I mean, there are some settings that you can play with, but I've got all the default settings, and I give you a list of tickers that I think are more likely to produce tradable signals than others. And it happens to be tickers that move about, a certain amount of dollars per day, and high ATR, as we call it. So
cool.
VVD beta, and it's a beta test. This is not refined. This is not like, great for the public. If you want to wait for the real release, it'll probably be a couple months down the road. The price will probably be higher than what it is now. This is a paid beta. We've kind of tested it with my VIP club so far, and everybody kind of likes it. Says it works most of the time. It does have a few quirks, and like I said, I've been correcting little errors where one of the errors I corrected this week, it was drawing multiple targets. As the new candles came along, I just typoed something, and now we've got it where the target stays fixed. So that's what we got.
Love it. All right, my man. Well, it's been great talking to you. If you ever want to do this again, I'm totally game for it.
Yeah, it seemed to be really popular, and
I think people get tired of watching other people read a PowerPoint. You know what I mean? This is great that we could just riff without a script and really give the people the best value we can.
Yep, this was 100% unscripted today, everybody. We didn't even have a meeting and talk about what we were going to talk about.
But hey, you always over deliver. I know that for a fact. So if anybody has any qualms about that, just don't worry about it. Go ahead and get this, and you'll be glad you did.
Yeah, this is a paid beta, and it is a test, and you get the lifetime access as part of that. The people getting it later aren't going to get lifetime access, so it's going to be a time limited indicator. So, right. All right.
Hey, let's try to do this again.
Yeah, let's see if we can put it together with the team. Maybe share our information with more people.
Our team flipped out. Just so you guys know, our team flipped out when we told them
they did not want to do this.
We want to have a talk with no PowerPoint. They're like, "Oh man, I don't know about that." Hey, but this was great, man. I loved it. I love talking to you. I think you're brilliant. Everybody should get in on this while they still can.
You're a wealth of knowledge, Jack. You're a wealth of knowledge right here.
Just because I'm old.
Hey, experience. There's a lot to be said about experience. You either buy your education or you pay for it. I mean, that's
I got a full head of hair. I had one of the most beautiful wallets on Wall Street. Now look at this. That's what
I used to have hair on top and not on the sides. Now I got hair on the sides and not on the top.
All right, my man. I'm gonna leave it right there. Good talking to you. I'll see you later.
Bye, everybody.